A wonderful day to you all. Welcome to Nifty Sense. We stand at a fascinating crossroads in the Indian markets today. While the headline numbers show a sea of red, did you notice the subtle clink of metal? Why is it that when the tech giants of the Nifty IT index were retreating, the iron and steel giants were standing tall? There is a silent transfer of power happening beneath the surface, and today, we unmask it. Think of the stock market as a massive global supply chain. If a major shopkeeper, like the US, threatens to increase the entry fee, tariffs, for goods coming from other shops, the suppliers, Indian IT and auto companies, get nervous. The cause? Uncertainty over the US-India trade deal and a pending US Supreme Court ruling on President Trump's tariff measures. The effect? FIIs, foreign institutional investors, pulled out money like a tenant moving out of an apartment before the rent increases. However, DIIs, domestic institutional investors, acted like a business insurance policy, buying the dip and preventing a total crash. Vedanta, relative strength. While the market slipped, Vedanta surged over 6%. This is a value moat built on commodity cycles. With silver prices predicted to skyrocket, Vedanta's institutional footprint is expanding. It's moving from a simple mining company to a critical resource bank. Union Bank of India, institutional footprint, up 8% today. Their Q3 profit rose 9%, but the real green flag is the dropping NPA, non-performing assets. Think of NPAs as bad debt in a local grocery store. When the store cleans up its books, the big investors, institutions, feel safe putting their money back in. Despite the index being red, the metal sector showed quiet, aggressive accumulation. As global inflation fears loom, investors are treating metals like infrastructure gold. It's the sector where the smart money is hiding, while the tech storm passes. The dark horse deep dive, the commodity supercycle. Why metals? The business insurance perspective. When the world is uncertain, people return to things they can touch. You can't build a bridge with software. You need steel. The moat. Companies like Vedanta and Tata Steel own their mines. In a world where trade routes are being blocked by tariffs, owning the raw material is like owning the insurance policy for the entire supply chain. The lesson. While others chase the shiny AI stocks, the strategist looks at the rusty steel stocks. Why? Because the PE ratio, price to earnings, of these metal giants is currently at a deep discount compared to their historical average. This is what we call a margin of safety. Do you see the invisible gravity with respect to global macro and currency? Imagine two massive water tanks connected by a pipe. One tank is the US dollar, USD, and the other is the Indian rupee, INR. When the US Federal Reserve changes interest rates, it's like changing the height of one tank.
As US Treasury yields spiked, water, or capital, naturally started flowing out of the INR tank into...
Why this matters to you? When FIIs, foreign institutional investors, sell 14,000 crore rupees in a single day, they aren't necessarily hating Indian companies. They are simply moving their water to the tank where the pressure, interest rate, is higher. The structural weakness. If the INR weakens too fast, the cost of oil, which India imports in massive quantities, goes up. This is like a hidden tax on every citizen. We call this imported inflation. The geopolitical friction, the customs gate. The headlines today regarding US-India trade tariffs act like a customs gate that has suddenly become narrower. IT services, the digital export. For years, Indian IT was like a seamless highway. Now with potential new regulations, that highway has speed bumps. This is why we see structural weakness in the IT index today. The strategy. As a strategist, I look for companies that don't need to pass through that customs gate. This brings us to domestic consumption. Companies that sell to Indians, for Indians. Let's decode the institutional footprint. When an institutional investor, like a massive pension fund or LIC, enters a stock, they are like an elephant getting into a bathtub. They cannot get in without the water level rising significantly. Accumulation zones. Notice the stock of Union Bank today. Despite the Nifty being down, the volume was 3x the 20-day average. The water level, price, stayed stable or rose. This tells us the elephant is stepping in slowly. FII-DII crossover. Think of this as a relay race. The FII is tired and wants to pass the baton. The DII, domestic mutual funds, is fresh and has SIP power, money from millions of regular Indian savers. Today was a perfect baton handoff. The DIIs bought 12,000 crore rupees plus because they see the long-term infrastructure moat of India. The wealth preservation masterclass. The garden fence strategy. Wealth preservation isn't about making 100% in a month. It's about not losing 50% in a week. Diversification as a fence. If all your plants, stocks are from the IT sector, one tariff storm kills your whole garden. The Rebalancing Act. Today's market taught us to move profits from overheated sectors, like some mid-cap tech, into undervalued sectors, like PSU banks or metals. This is like trimming the overgrown hedges to let the smaller plants get sunlight. The anatomy of the invisible hand, market mechanics. The oxygen of the market, liquidity and volatility. Imagine the stock market as a deep-sea diver. To survive and move, the diver needs a constant supply of oxygen. In financial markets, liquidity is that oxygen. The squeeze today, we saw a liquidity squeeze in mid-cap IT stocks. When everyone wants to exit at the same time, the door, liquidity, becomes too small. This causes the price to drop much faster than the actual value of the company. The lesson: as a strategist, I don't look at the price. I look at the bid-ask spread. If the spread is widening, it's a sign that the oxygen is running low. This is when the smart money waits for the bottom. The whale versus the school of fish. Order flow. Retail investors often act like a school of fish. When one turns, they all turn. This creates high-frequency noise. However, institutions, the whales, move differently. Iceberg orders. Today, in the metal sector, we saw evidence of iceberg orders. A whale wanted to buy 1 million shares of Tata Steel, but didn't want the price to spike. So they placed 1,000 small orders of 1,000 shares each. How to spot it? Look at the VWAP, volume-weighted average price. If a stock is trading consistently above its VWAP while the overall market is falling, it's a clear sign that a whale is absorbing all the selling pressure. This is a massive green flag. The echo chamber warning, narrative versus reality. The media will tell you the market fell because of tariffs. That is the narrative. But the reality is often different. Mean reversion. Many IT stocks were trading at a PE ratio 40% higher than their 10-year average. They were stretched like a rubber band. The tariff news wasn't the reason for the fall. It was just the pin that popped the bubble. The strategist's view, we call this mean reversion. Eventually, everything returns to its average. Today's drop in overvalued sectors is simply the market returning to its natural state. The behavioral symphony, the psychology of wealth, the home bias, and the global flight. Think of a person during a sudden thunderstorm. Their first instinct is to run home. In the world of finance, home for global capital is the US dollar. The flight to safety, when geopolitical news, like the 2026 tariff updates, creates thunder, foreign investors, FIIs, pull their umbrellas back to their home base. This isn't a reflection of India's failure, it's a reflection of global fear. The opportunity. While the visitors, FIIs, are running for the exit, the locals, DIIs, know the roof isn't actually leaking. They stay and collect the assets left behind at a discount. The recency bias trap. Human beings are hardwired to believe that what happened yesterday will happen tomorrow. The trap. Because the market has been volatile for the last few sessions, the school of fish, retail investors, assumes it will fall forever. They sell at the bottom. The strategist's counter. We use the institutional footprint to break this bias. We look for divergence. If the news is bad, but the stock price stops falling, the bad news is already priced in. The market has already swallowed the bitter pill. The master's equilibrium. Professional real-world analogy. Imagine a commercial pilot flying through turbulence. A passenger, retail investor, looks out the window, sees the wings shaking, and panics, thinking the plane is falling. The pilot, strategist, looks at the instruments, cash flow, order books, debt to equity. The pilot knows the plane is designed to flex. The turbulence is just displaced air. Today's lesson. Don't look out the window at the red screen, the shaking wing. Look at the instruments, the company fundamentals. If the engine, earnings, is still running hot, the plane will reach its destination. If you cannot watch your portfolio drop by 20% without panicking, you should not be in the market. But if you can watch a 20% drop and see it as a 20% clearance sale on a luxury brand, you have already won the psychological war. Today's lesson. Volatility is the tax you pay for long-term returns. Wealth preservation isn't about avoiding the storm. It's about owning the umbrella. Stick to sectors with domestic resilience when global winds are harsh. Markets don't go up in a straight line. They breathe. Today was an exhale. Tomorrow we look for the next deep breath. See you all tomorrow.